Hello everyone. Hope you all are fine and maintaining the social distancing norms. Friends, as an initiative to make the optimum utilization of this quarantine period, we at Vinod Kothari and Company have started this YouTube channel whereby we try to discuss regarding the provisions of Companies Act, FEMA regulations, SEBI regulations and other knowledge gaining topics. Friends, the idea is to share knowledge. So those who have not yet subscribed the channel may please subscribe the same in order to be updated with the latest sessions. Today we are going to discuss regarding cross-border mergers. The concept of cross-border merger is specifically defined in explanation 1 to section 232 of Companies Act, which provides for two kinds of merger. First one is merger by absorption, where an existing company absorbs or undertakes another existing company or more than one existing company. And the second one is merger by formation of a new company, wherein two or more existing companies come together, consolidate their assets, and convert themselves into a newly formed entity. I have already given a brief regarding Section 230 and 232 of Companies Act 2013 in my earlier video discussion. So, in today's discussion, we are going to focus on cross-border mergers only from the Companies Act perspective and from the FEMA perspective as well. When I say cross-border merger, the instant idea that we get about the topic is merger between an Indian company and a foreign company. The idea is correct to some extent, as it does provide for merger of an Indian company with a foreign one and vice versa. However, it is not just limited to the provisions of Companies Act 2013. As the entities incorporated outside India are also getting indulged in the process, the FEMA regulation also becomes equally important here. So here, two companies of two different jurisdictions are involved. First one is Indian company. Definition has already been provided in Companies Act. And foreign company. Foreign company means any company, body corporate, incorporated outside India, whether having a place of business in India or not. Jurisdiction of eligible foreign companies has been provided in Annexure B of Compromise Arrangement and Amalgamation Rules for the cross-border merger. We'll discuss about that at a later part. Friends, the initial step towards cross-border merger was taken in 2005 by J.J. Irani Committee with an intention to widen the scope of business internationally. However, ensuring compliance with the law of respective countries was really a tough job. Earlier, Indian companies were required to set up branches in the foreign territory so that they could merge with the foreign entity and grow bigger. However, direct merger was not permitted in the erstwhile act. There are certain examples of global acquisition as well. A few noted examples are as of Tata Motors acquiring Jaguar, Mittal Steel acquiring Arcelor, and so on. In the erstwhile act, cross-border merger was very limited, since it only recognized the situation wherein the resultant company, that is a transferee company, would be an Indian company and not vice versa. The difference was highlighted in section 394 subsection 4b of the erstwhile act itself, that provides that transferee company does not include any company other than a company within the meaning of this act, but transferor company includes any body corporate, whether a company within the meaning of act or not. Thus, the concept of transferor company was liberal in comparison to the transferee company in the erstwhile act. And therefore, the act in this respect, with the growing need of Indian economy, had become outdated, since it was not in line with the impliedly encouraged principle of globalization. However, the new Companies Act 2013 provides that, subject to the provision of any other law for the time being in force, a foreign company may, with the prior approval of Reserve Bank of India, merge into a company registered under this act or vice versa. So the new act is flexible towards the inbound and outbound, both kind of investments and both transactions. Simultaneously, Rule 25A has been inserted in by MCA in the Compromise Arrangement Rules that deals with the cross-border merger, and thereafter FEMA also introduced cross-border merger regulation. This regulation was introduced in 20th March 2018, and that provides for detailing regarding the inbound and outbound merger. So basically in India, cross-border merger is majorly regulated by Companies Act, SEBI SAST regulation in case listed companies are involved, Competition Act, Income Tax Act, DIPP, Transfer of Properties Act, Indian Stamp Act, of course, and FEMA, and the allied laws as may be applicable based on the merger structure. The two most relevant regulation under FEMA from a merger and amalgamation perspective when it comes to cross-border merger are FEMA transfer or issue of securities by a person resident outside India regulation 2000, which is FDI regulation, and FEMA exchange management, foreign exchange management, transfer or issue of any foreign security regulation 2004, which is ODI regulation. In addition to this, as I already mentioned, RBI has notified Foreign Exchange Management Cross-Border Merger Regulation 2018, which has become effective from the date of its publication in Official Gazette itself, which was 20th March 2018. This regulation particularly focus on merger amalgamation between Indian company and foreign company, covering inbound and outbound investments. So, under Companies Act 2013, cross-border merger could be either inbound merger or outbound merger. Inbound merger, wherein foreign company is getting merged into an Indian company, and outbound is just opposite to that, wherein an Indian company is getting merged to a foreign company. The condition that needs to be adhered to for the inbound and outbound merger has been provided in FEMA cross-border merger regulation. Regulation 4 provides for inbound merger and Regulation 5 provides for outbound merger. So just quickly see the specific requirements for inbound merger that one has to adhere to in order to file application or in order to proceed with the inbound merger. Just like in case of domestic merger, wherein the transferee companies are required to issue shares to the shareholder of the transferor company post-merger. Similarly, in case of inbound or outbound merger as well, the respective resultant company has to issue shares or securities to the transferor company, to the shareholders of the transferor company. As a consideration, in case of inbound merger, as a consideration, the Indian company would issue or transfer securities to the shareholders of the transferor entity, which may or may not include person resident in India. So there may be person resident outside India as well. In case of person resident outside India, the issuance of security shall be in accordance with the pricing guidelines, sectoral cap, and other applicable provisions as provided in RISPRO. Now, this RISPRO has been superseded by NDI rules. NDI rules has been discussed by my colleague Ms. Vinita Nair in detail in a separate video discussion. So I'm not going into detail of NDI rules here. We'll focus in the process only. So there may be case where the foreign company is a joint venture or WOS of the Indian company, and the Indian company intends to merge its WOS. In that circumstances, it has to comply with the provision of ODI regulation issued by RBI. If the inbound merger of a joint venture or WOS results into an acquisition of one or more step-down subsidiary of joint venture or WOS of the Indian company by the resultant Indian company, then such regulation should be in compliance with Regulation 6 and 7 of ODI regulation. Now the question arises at this point of time is, what will happen to the borrowing or guarantees or assets and liabilities of the transferor company? The transferor company in case of inbound merger is a foreign company. So what will happen to the borrowing, guarantees, assets, liabilities of that company? As regards borrowing and guarantees of the transferor company, the foreign company, the FEMA regulation provides that pursuant to merger, any overseas guarantee or borrowing of the foreign transferor company, which becomes the borrowing of the resultant company, must conform within 2 years with the applicable FEMA rules such as ECB direction, foreign exchange management guarantee regulation, etc. But it simultaneously also provides that no remittance for repayment of such liability can be made from India within a period of 2 years. So one can say that there is a moratorium period for 2 years, wherein no payment regarding those borrowing or guarantee can be made from India to outside country. Now, what will happen to assets and liabilities? So there may be assets which Indian companies are permitted to acquire, or there may be assets that Indian companies are not permitted to acquire. The resultant company, if the resultant company, normally in case of merger, what happens is assets and liabilities of the transfer company becomes the assets and liabilities of the resultant company. The resultant Indian company, in case of inbound merger, can acquire or hold or transfer the assets outside India in accordance with the FEMA regulation. However, if the resultant Indian company is not permitted under FEMA regulation to acquire or hold any asset or security outside India, then it has to sell the assets within a period of 2 years from the date of sanction of the scheme. The sale proceeds has to be repatriated immediately to the Indian company, to India. So the transfer company's asset, if not permitted by FEMA to be acquired by the Indian company, in that situation, that asset has to be sold in that country itself, and the realized proceeds has to be repatriated to India. What will happen to the liabilities? So it says that in case the resultant company is not permitted to hold any liability in the other company, in the other country, in that situation, it has to extinguish this liability from the sale proceeds. Similarly, in case of outbound merger as well, there may be situation where an Indian company is having borrowing or guarantees, or Indian company is having assets and liabilities. So what will happen to those borrowing? What will happen to those assets and liabilities? The foreign company, first of all, should be incorporated in the jurisdiction as provided in Annexure B of the Compromise Arrangement Rules. Now, the person resident in India holding shares in an Indian transfer company can acquire or hold securities of the resultant foreign company in accordance with FEMA transfer or issue of any foreign security regulations. If such a shareholder is an Indian shareholder, such acquisition must be in accordance with liberalized remittance scheme. As regards guarantee or outstanding borrowing, again there is a provision that it has to be as per the sanction scheme in terms of company's rules only. The resultant company, foreign company, can acquire or hold or transfer the assets in India as per the FEMA regulation. However, if it is not permitted under FEMA regulation to hold any asset or any security in India, in that situation, again, it has to sell the assets within the period of 2 years, and the realized proceeds has to be repatriated to the other company wherein the resultant company is situated. And if there are any liabilities which the foreign company is not permitted by FEMA to hold, in that situation, it has to extinguish the liabilities within the period of 2 years from that realized proceeds. There may be other situations as well. Now, say suppose if the the transferor company has office. So what will happen to that office? In this situation, we can take in two circumstances. First one can be in case of WOS or JV of the Indian company. In case of inbound merger, first we are discussing. So say suppose if in case of inbound merger, the other company is having office at foreign country. If the the transfer company is a wholly owned subsidiary, in that situation, the entire shares of that company are held by me only, and the assets and liabilities have already been transferred. So I'm not required to hold any particular office in that country. However, in the other situation, that particular office of the transfer company will be treated as branch or office of the resultant company in accordance with FEMA rules only. It says that for the sale proceeds. Now, as I already mentioned, that the assets has to be sold in that country, and the realized proceeds has to be repatriated. So, how to repatriate? There has to be mode of repatriation as well, no? So, for that repatriation, there has to be a bank account. For this, the FEMA regulation provides that the bank account can be opened by the resultant company in the jurisdiction of the transferor company for carrying out the transaction incidental to the cross-border merger for a maximum period of 2 years from the date of sanction of the scheme. Now, the first and foremost thing which is mentioned in the cross-border merger is that before opting for the cross-border merger route, one has to ensure that all the non-compliances, all the contraventions, violations, as the case may be, of the Act or other rules framed thereunder shall be completed. So there should not be any due proceedings left before opting for the cross-border merger. This is the prerequisite for opting for cross-border merger. Obviously, for cross-border merger, there is an important role of RBI. So the companies have to report to RBI from time to time. There is no particular format provided for reporting as such for the time being. However, the format may be provided by RBI. Even if there is no format provided, the companies are required to report to the regarding the progress in the matter to the RBI. And as regards the valuation, just like we have to do valuation in case of normal merger, in case of cross-border merger as well, valuation has to be done to determine the share exchange ratio, and that valuation has to be done in accordance with internationally accepted principles of accounting and valuation. Now let us quickly see regarding the process of merger. As section 234 itself provides that provision of chapter shall apply mutandis mutandis in case of cross-border merger. Application under section 230 of the Act has to be filed to the tribunal by either party, wherein having the jurisdiction before the respective NCLT. Tribunal may call for the meeting of members or creditors or both for the purpose of obtaining approval of the proposed scheme through voting by such members or creditors or both, and entertaining their objection if they have any with respect to the proposed scheme. Merger would become binding if 3/4 of the creditors in their total debt value and members in their total shareholders value, as the case may be, vote in favor of the cross-border merger, in favor of the scheme basically, and if the scheme is approved by NCLT. The requirement of meeting of creditors or shareholders may not be required if the respective companies will be able to take consent by way of affidavit from their creditors and shareholders of at least 90%. So when it comes to creditors, consent of at least 90% of the total debt of the company, and when it comes to members, consent of at least 90% of the total paid up share capital of the company is required in order to get dispensation from the meeting of from the NCLT convened meeting. Along with the application, certain necessary information relating to the company and its business, especially certificate by the company's auditor as to accounting treatment of the company, has to be filed before the NCLT so that it can ascertain the colorable nature of the proposed scheme if so exists. The notice of the meeting along with its creditors and members, as we are required to send, we have to send to the notice to the respective regulatory authorities as well, such as central government, which is regional director, and income tax authority, RBI, SEBI, Competition Commission of India, registrar, respective stock exchanges, and official liquidator. Each of them, on receiving of such notice, shall be allowed to raise objection to such proposed scheme within a period of 30 days. If no objection received from any of the regulatory authority, in that circumstances, NCLT will approve the scheme, and the order of NCLT has to be filed with the registrar of companies of the respective company within the period of 30 days. So this is the process of the cross-border merger. Now let us quickly see the process at a glance. So cross-border merger is about foreign company and Indian company's amalgamation, wherein we have to follow rules as prescribed by central government and Reserve Bank of in consultation with the Reserve Bank of India. Why Reserve Bank of India? Because foreign company is involved here. Mandatory approval of RBI, though section 234 of the Companies Act 2013 as well as rule 25A inserted in the compromise arrangement rules provides for mandatory approval of RBI in case of cross-border merger. However, FEMA has come up with the regulation that provides for deemed approval as well. We'll discuss about deemed approval in some time. So like in case of normal merger, the consideration has to be paid to the shareholders of the transferor company. Simultaneously, in case of cross-border merger as well, the consideration has to be paid to the shareholder. The consideration can be in the form of cash, depository receipt, or partly in cash, partly in depository receipt. If RBI's approval is not granted, in that situation, NCERT will not be able to approve the scheme. If RBI's consent is received by the NCERT, in that situation, NCERT will approve the merger of the Indian company with the foreign company. So this is the process at a glance of cross-border merger. Now, as I told regarding the deemed approval of RBI. Friends, Regulation 9 of FEMA Cross-Border Merger Regulation 2018 provides for deemed approval of RBI. So there are two situations that has to be followed in order to in order to avoid the specific approval of RBI. The situation as provided in the FEMA regulation is that it says that any transaction on account of a cross-border merger undertaken in accordance with these regulations shall be deemed to have prior approval of Reserve Bank as required under Rule 25A of the Company's Compromise Arrangement and Amalgamation Rules 2016. Second one is a certificate from the Managing Director, Whole-Time Director and Company Secretary, if available, of the companies concerned ensuring compliance of these regulations shall be furnished along with the application made to the NCLT under compromise arrangement rules. So the basic requirement is a certificate from the managing director and whole-time director, managing director or whole-time director and company secretary of the company, if there is any, confirming that they will ensure the compliance of the FEMA regulation. So this certificate is important. If they ensure the compliance of the necessary regulations of FEMA, in that situation, NCLT will not ask for specific prior approval of RBI, as the certificate will be treated as deemed approval from the end of RBI. In fact, there are situations where NCLT has approved the scheme of cross-border merger. There are two recent example of NCLT approved cross-border merger. First was in case of Trisa Jewels and 7 others, wherein the cross-border merger was approved by Chennai bench, and the other one was Reliance Life Sciences Private Limited, wherein the scheme was approved by NCLT Mumbai bench. In both the situation, the whole-time director and the company secretary of the company has provided certificate in terms of Regulation 9 of the FEMA regulation, and based on that certificate and based on the no objection received from any of the regulatory authorities, NCLT approved the inbound merger of cross-border merger. One of the important questions dealt before the NCLT Ahmedabad bench was whether this cross-border merger section 234 of the Companies Act provides for demergers as well, or does the provision also encompasses cross-border demerger or any similar transaction as well. The NCLT answered that the scope of section 234 is narrow and covers only cross-border merger and amalgamation and not demerger cases. This was the case of Sun Pharmaceutical Industries Limited and decided on 19 December 2019. The demerged Indian company was Sun Pharmaceutical, whose securities were listed in Indian stock exchanges. That company proposed to demerge 2 of its specified investment undertakings to 2 of its wholly owned subsidiaries, being the resultant companies. One of the company was incorporated in Netherlands and the other one was in United States. The transaction got approval of the majority of shareholder. This was basically a demerger assignment, and the transaction got approval of the creditors and members as required. In fact, none of the regulatory authorities raised any objection. However, NCLT at the last stage was concerned with the essential question of whether cross-border merger was permissible at all under Companies Act, and whether cross-border demerger basically is permissible under Companies Act. And finally, it declines the application based on the decision that section 234 is limited to mergers only and not demergers. Now let's discuss regarding the taxation aspect in case of cross-border merger. We all know that in case of domestic amalgamations or mergers, domestic amalgamation or mergers are tax neutral, since the transaction by way of amalgamation has not been treated as transfer under Companies Act 2013, Companies Income Tax Act 1961. Now, the definition of amalgamation has been provided under section 2, subsection 1b of Income Tax Act. It says that all the properties and liabilities of the merging company immediately before the amalgamation should become the properties and liabilities of the amalgamated company, and 75% shareholders of the amalgamating company have to remain as a shareholder of the amalgamated company. So if these two situations satisfied, in that situation, the transaction shall be treated as amalgamation, and amalgamations are not treated as transfer. Now the question arises at this point is whether merger with a foreign company will also enjoy the tax neutrality. The answer is yes, because the definition of company as provided under Income Tax Act includes body corporate incorporated by or under laws of country outside India as well. Now let us see the tax implication in the hand of shareholders of the transferor entity. In case of amalgamation, the shareholders of the transferor entity receive shares of the transferee entity in lieu of their shareholding in the transferor entity. Just like in the domestic merger, the same thing happens in case of cross-border merger as well. This then raises the question as to whether the process will be considered as transfer and therefore will be subject to capital gain tax in the hand of shareholders or not. As I said, the amalgamations are not treated as transfer, and hence no capital gain tax is levied. In this regard, the Indian tax law provides exemption that in case of amalgamation, any transfer of shares in the transferor entity by the shareholders will not be liable to capital gain taxes on the fulfillment of two conditions. Again, in the hand of shareholders as well, there are two conditions. First one is that the shareholders of the transferor entity receive shares of the transferee company in consideration to the transfer, and the second one is transferor entity is an Indian company. However, one interesting question here is to note that no specific capital gain exemption is provided to the shareholders under the income tax law in case of amalgamation between a foreign company involving transfer of shares of an Indian company or a foreign company which derives its value substantially from the shares of an Indian company, wherein the shareholders receive shares in the transferee foreign entity in lieu of shares in the transferor foreign entity. So in that regard, there is no exemption. Thus, in case of inbound merger, a foreign company merges with an Indian company and the amalgamated entity is an Indian entity. Amalgamation enjoys tax neutrality with respect to transfer in respect of capital gain taxes as well as in the hand of shareholders. In fact, this entire provision does not include any of the does not specifically provides for the cross-border merger, specifically when the transferee company is a foreign company. Now let us discuss regarding the cross-border losses as well. Amalgamated company have the privilege of setting off of depreciation and carry forward of unabsorbed or accumulated losses according to its accrued profit. The same is, however, not available to the public company where shareholders carrying 51% of the voting right of the last date of years in which the set-off is short are different from the shareholders carrying 51% of the voting right on the last date of the year in which the given loss was incurred by the company. Carry forward of losses is applicable only in the sectors where specifically provided by Income Tax Act or notified authority. As I already mentioned regarding outbound merger, that in case of outbound merger, wherein Indian company merges with a foreign company and amalgamated company is a foreign company, the IT Act is presently silent and there is no particular exemption provided. So till the time there is any amendment has been brought by the government, this transaction will be recognized as a transaction, as a transfer, and necessary taxes may be levied on that. As of now, there is no particular cases of outbound merger dealt in India for the time being, as NCERT is also hesitating in entertaining the cases regarding outbound merger. One question that arises here at this point of time is, why opting for merger in case of wholly owned subsidiary? Now, say suppose if I am an Indian company and I have a wholly owned subsidiary in a foreign country, so I can opt for voluntary liquidation of that foreign WOS of mine as well. Why to opt for mergers only? The answer to the question lies in section 222C of the Income Tax Act, which says that the sale proceeds amount to the extent of accumulated profit will be treated as dividend, and accordingly dividend distribution tax will be levied on that. Whereas the merger of the foreign company with the Indian one is tax neutral, and hence the company mostly opts for cross-border mergers only instead of closing the companies in the by way of liquidation. Now coming to stamp duty and registration part. As we all know, stamp duty is a state affairs. The transfer of assets, particularly immovable property, requires registration with the state authorities and payment of stamp duty for the purpose of authenticating transfer of title. Stamp duty rates differ from state to state. In case of movable properties, in case of immovable properties, different rates are already provided. The same is calculated on the amount of consideration received for the transfer of the market value of the property transferred. Uh, this has been calculated on the basis of market value of the immovable property transferred or market value of the shares issued or consideration paid by the resultant company, whichever is higher. In fact, there are some states wherein special beneficial provisions pertaining to stamp duty has been provided in case of court-approved merger as well. Now, this is the basic regarding the cross-border merger. Coming to the challenges or the loopholes in case of cross-border merger, the very first challenge is quite apparent that there might be various conflicts in the compliances of laws of concerned jurisdiction. Not every country confers even statutory recognition of cross-border merger. Like section 47(6) and 7 of the Income Tax Act that exempts inbound merger from the taxation, while law is silent regarding the issue for outbound merger. And therefore, the transaction of inbound merger would be taxed till corresponding amendment are brought into force by the government in consonance with the Companies Act provisions. One of the issue faced by foreign company under the corporate setup is India is the challenge of repatriating profit earned out of the Indian business. For instance, if an Indian company declares dividend to its foreign shareholder, it is liable to dividend distribution tax under section 115(o) of Income Tax Act, which is 20%. Alternatively, Indian company may consider to distribute its accumulated profit to the foreign shareholder as buyback or reduction of its share capital. In the former case, in case of buyback, it will be liable to buyback tax as per section 115 QA, or in case of reduction of share capital, there will be dividend distribution tax to the extent of accumulated profit and also capital gain over and above the same. So, since these taxes are directly borne by the Indian company and not by the recipient shareholder, it may not be possible to obtain foreign tax credit in some jurisdiction. This will also lead to double taxation on the net dividend income. So friends, one can say that the process of merger, the cross-border merger specifically, is not that easy, which it appears merely from the foreign exchange management rules and regulation and the Companies Act provisions. Rather, number of other regulatory bodies are also involved in the transaction, such as SEBI is involved. There is a limit under Competition Act as well, which is provided in Section 5 of Competition Act that has to be met. So whenever such transaction is proposed to be performed, then cooperation between such authorities of two or more jurisdiction is also highly recommended. The Companies Act 2013 was a step towards smooth function of cross-border merger, which is evident from its inclusion of outbound merger, but still there are needs to deal with cross-border merger more specifically and separately from the domestic merger and amalgamation. Just like in case of domestic merger, detailed process has been provided in the compromise arrangement rules and in the act itself. The provision of section 234 is very narrow comparing to that. So one needs specific clarification regarding the implementation of the section and the detailed procedure to be followed as well in case of inbound merger as well as in case of outbound mergers as well. The same goes with competition law as well. Since there is no bifurcation on the procedure between domestic and cross-border merger, NCLTs are also hesitating in entertaining cases pertaining to outbound merger. So this is all about cross-border merger today. With this, I am concluding today's discussion. If there are any topics in which you want us to take sessions, Please do let us know pertaining to this particular topic. If you have any query, please drop your query at corplaw@vinodkothari.com. Thank you.